The primary pillar of the bullish thesis for Accenture rests on the firm's successful anticipation and capitalization of the generative AI wave. Unlike previous technological cycles, Gen AI requires a fundamental redesign of the enterprise digital core, a task that plays directly into Accenture's strengths in large-scale systems integration and strategy consulting. In fiscal year 2023, the company committed $3 billion to a multi-year investment in data and artificial intelligence, a move that is now yielding significant financial results. By the end of fiscal 2025, Accenture had tripled its generative AI-related revenue to $2.7 billion compared to the previous year. More importantly, its Gen AI bookings nearly doubled during the same period, reaching $5.9 billion. This trajectory indicates that the firm is successfully moving clients from small-scale proofs of concept to enterprise-wide production. The acceleration is even more pronounced in the first quarter of fiscal 2026, where advanced AI new bookings reached $2.2 billion in just 3 months.
Accenture's leadership in this space is supported by a massive reskilling effort. The company grew its AI and data workforce from 40,000 professionals in 2023 to over 85,000 by the second quarter of fiscal 2026. This workforce is not merely theoretical. They worked on more than 6,000 advanced AI projects in fiscal 2025, providing the company with a repository of proprietary assets and lessons learned that smaller competitors cannot match. The transition from generative to agentic AI, where autonomous agents perform complex tasks, is the next frontier for the firm. Accenture's reinvention engines and specialized platforms like GenWizard are designed to embed these agents directly into client workflows. GenWizard, for instance, is a generative AI platform that can reduce IT costs by 50 to 75% for certain technology delivery modules, while improving speed to market by 5 to 8 times. This capability allows Accenture to deliver superior value to its clients, positioning itself as an indispensable partner for organizations seeking to navigate the complexity of AI-driven transformation.
The bull case suggests that as AI maturity increases across industries, the gap between AI achievers and laggards will widen. Accenture's research indicates that only 12% of firms have currently reached a high level of AI maturity, yet these firms enjoy 50% greater revenue growth than their peers. As more of the Fortune Global 500 strive to become achievers, Accenture stands ready to capture this demand through its integrated reinvention services unit, which brings together strategy, technology, and operations under a single delivery model. The second pillar of the bullish thesis focuses on the stability and defensive characteristics of Accenture's business model, specifically its massive managed services engine and its unparalleled diamond client base. In an uncertain macroeconomic environment, enterprises prioritize cost optimization and operational resilience, driving demand for outsourcing and managed services, a segment where Accenture is a global leader.
In the second quarter of fiscal 2026, managed services revenues reached $9.18 billion, a 10% increase in US dollars and 5% in local currency. This growth reflects a structural shift in how clients view outsourcing. It is no longer just about labor arbitrage, but about using technology-enabled platforms like SynOps to reinvent entire business functions. Managed services provide Accenture with a steady stream of recurring revenue that dampens the cyclicality often associated with discretionary consulting projects. Accenture's competitive moat is further solidified by its long-term relationships with the world's largest organizations. The company serves approximately 9,000 clients, including 3/4 of the Fortune Global 100 and 500. The diamond clients, those representing the largest and most significant relationships, reached 305 by the end of fiscal 2025. 195 of the top 200 clients have been with Accenture for a decade or more. This client stickiness creates a virtuous cycle. Because Accenture is deeply embedded in its clients' operations, it is often the first partner invited to help solve new challenges, such as cloud migration or AI integration. In the second quarter of fiscal 2026, the company reported a record 41 clients with quarterly bookings greater than $100 million, suggesting that even as budgets tighten, the largest enterprises are concentrating their spend with a single trusted provider.
Furthermore, nearly 80% of Accenture's large deals are now multi-service, meaning they involve multiple capabilities across the firm's portfolio. This integration makes it significantly more difficult for niche competitors or smaller consulting firms to displace Accenture, as they lack the scale to deliver end-to-end reinvention across a global footprint. the company's presence in 120 countries and its deep industry expertise across 13 distinct verticals, from banking to life sciences, allow it to bring localized, sector-specific solutions that are increasingly required in a world of fragmented regulation and data sovereignty. The third bull case argument centers on Accenture's robust financial profile and its disciplined approach to capital allocation. The company's asset-light, services-driven model consistently generates significant free cash flow, which management uses to fund strategic investments and return substantial value to shareholders. In fiscal year 2025, Accenture delivered $10.9 billion in free cash flow, and for fiscal 2026, the company raised its full-year guidance to a range of $10.8 billion to $11.5 billion. This strong cash position allows the firm to invest through cycles, a luxury not afforded to many of its more leveraged or smaller peers. During fiscal 2025, the company returned $8.3 billion to shareholders, reflecting a commitment to being one of the top capital return machines in the S&P 500.
The company's dividend and buyback history are particularly compelling for long-term investors. In the second quarter of fiscal 2026, Accenture returned $2.7 billion to shareholders, including $1 billion in dividends and $1.7 billion in share repurchases. The quarterly dividend of $1.63 per share represents a 10% increase over the prior year, continuing a long trend of double-digit dividend growth. Accenture's balance sheet is characterized by low leverage and high liquidity. As of February 28, 2026, the company held $9.4 billion in cash and equivalents against long-term debt of $5 billion. This conservative leverage, a debt-to-equity ratio of 0.16, gives the company the flexibility to pursue large-scale acquisitions, even when interest rates are elevated or debt markets are tight. Moreover, the company has shown a unique ability to expand its operating margins despite the costs associated with its AI pivot and workforce optimization. The adjusted operating margin for fiscal 2025 was 15.6%, and for fiscal 2026, management expects a GAAP operating margin expansion of 50 to 70 basis points, targeting an adjusted range of 15.7% to 15.9%. This margin discipline is achieved through internal automation, the use of proprietary AI tools in delivery, and a shift toward higher-margin, technology-led services. For investors, this suggests that Accenture is not just a growth story, but a highly efficient cash generation engine that is effectively balancing investment in the future with immediate shareholder rewards.
The final pillar of the bullish thesis is Accenture's mastery of the M&A lifecycle and its dominant position within the broader technology ecosystem. Accenture has transformed M&A from a series of opportunistic deals into a systematic, programmatic engine that serves as a primary driver of its technological capabilities and market expansion. Over the past 5 years, the company has invested an average of more than $2 billion annually in acquisitions. For fiscal 2026, this pace has accelerated significantly, with management now expecting to deploy approximately $5 billion in capital for strategic acquisitions. The goal of these string of pearls deals is threefold: scaling into high-growth areas, deepening industry expertise, and acquiring critical new skills. Recent acquisitions demonstrate this strategic focus. For example, the acquisition of Momentum ABM in late 2025 strengthened Accenture Song, the firm's tech-powered creative group, by adding advanced account-based marketing capabilities for B2B growth. In the industrial space, the integration of firms like Umlaut has added thousands of experts in digital engineering and manufacturing, positioning Accenture to lead the Industry X revolution, where physical operations meet digital intelligence.
Accenture's ability to successfully integrate these acquisitions is a key competitive advantage. The company has a dedicated post-merger integration team that ensures talent is retained and unique capabilities are preserved while being plugged into Accenture's global distribution channel. This allows organic growth through inorganic acquisitions, where a small acquired company can suddenly serve the largest corporations in the world through Accenture's platform. Parallel to its M&A strategy is its hegemony in the technology ecosystem. Accenture acts as the primary bridge between the major hyperscalers, AWS, Azure, Google Cloud, and enterprise clients. In fiscal 2026, the firm is on track to more than double its bookings from emerging AI and data ecosystem partners. By being the partner of choice for the world's leading software and cloud providers, Accenture ensures that it is always at the center of any major technology shift.
As these partners release new AI-driven tools, Accenture is the firm that helps the world's largest enterprises actually deploy and derive value from them, effectively capturing a consulting tax on the entire innovation economy. The most profound threat to the bearish thesis is what many analysts call the AI paradox. The very technology that Accenture is selling to its clients, generative AI, is intrinsically designed to automate the tasks that have historically formed the core of the firm's revenue model. If AI can do the work of 5 junior consultants in a fraction of the time, the traditional billable hour model faces an existential crisis. Critics point to the kill shot scenario, where AI-driven substitution happens much faster than the company can transition to new revenue models. Consulting projects that previously sustained teams of analysts for 18 months may now be compressed into 6 months or less as AI automates data analysis, code generation, and process mapping. This reduction in billable volume could lead to a structural decline in the size of consulting engagements. Furthermore, as AI tools become more turnkey and accessible, some enterprises may choose to build their own capabilities in-house rather than paying premium rates for outside consultants. If a client can use an AI agent to handle system maintenance or process management, tasks typically performed by Accenture's managed services teams, the value proposition of outsourcing is severely diminished. There is evidence that this pressure is already impacting the firm's operational metrics. For the 9 months of fiscal 2025, the company's cost of services grew by 9%, which actually outpaced its 8% revenue growth in local currency. This suggests that the current AI boom is a margin-dilutive activity, as the company must spend heavily on high-priced AI talent while facing pricing pressure on traditional services.
While Accenture is exiting thousands of staff members who cannot be reskilled, including 11,000 layoffs in 2025, there is a risk that this right-sizing will not be enough to offset the falling demand for traditional labor. If the market for AI services turns out to be more commoditized and less labor-intensive than traditional digital transformation, Accenture's massive headcount, nearly 790,000 people, could transform from a competitive advantage into a structural burden. The industry has historically grown at 7 to 8% annually based on increasing complexity. If AI simplifies that complexity, the entire sector's growth ceiling may be permanently lowered. The second pillar of the bear case is the immediate and sustained pressure from a cooling global economy, which has led to a significant pullback in discretionary consulting spend. While Accenture's managed services have remained resilient, its higher margin strategy and consulting work is increasingly vulnerable to corporate budget cuts. In second quarter of fiscal 2026, consulting revenues grew by only 3% in local currency. This follows a period where demand for consulting remained muted, particularly in North America. As corporate earnings face pressure from cost of living increases, tariffs, and geopolitical risks, many firms are deferring transformation projects that do not have an immediate and guaranteed ROI. The U.S. economy, for instance, mustered only 1.4% GDP growth in the final quarter of 2025, and manufacturing and consumer spending have remained soft into early 2026.
Specific areas of the business are showing acute signs of stress. The health and public service vertical, historically a bastion of stability, saw a 1% revenue decline in local currency in Q2 2026. The company's U.S. federal business is expected to create a 1% drag on total revenue growth for fiscal 2026, driven by budgetary uncertainty and the lingering effects of government shutdowns. Furthermore, the company disclosed it is cooperating with a U.S. Department of Justice investigation regarding its federal services, which introduces a headline risk that could jeopardize future government contracts. The bear case also highlights the risk of interest rate fatigue. While the consensus expects central banks to ease rates, the persistence of tariff-related cost pressures and high industrial inflation may limit the scale of those cuts. For a firm like Accenture, which thrives on the capital expenditure cycles of its clients, a higher-for-longer interest rate environment effectively chokes off the funding for the multi-billion-dollar transformation projects that the firm relies on to drive growth. Without a re-acceleration of discretionary spend in the Americas and EMEA, Accenture's 3% to 5% local currency revenue growth target for fiscal 2026 may be the new ceiling rather than a temporary floor.
A third bear case argument focuses on the internal operational health of the firm. Accenture is fundamentally a human capital business, and there are mounting signs that the current pace of technological change is pushing its workforce to a breaking point. One of the most concerning metrics for bearish analysts is the spike in voluntary attrition.
In fiscal 2025, annualized voluntary attrition reached 16%, up from 14% in the prior year. A professional services firm that loses 16% of its talent annually is a leaky bucket, incurring massive costs to recruit, onboard, and train replacements. This high churn rate is often a signal of burnout and low morale, particularly as the workforce is pressured to rescale or exit in the face of AI automation. The competition for specialized AI talent is also becoming an arms race. While Accenture is training 550,000 workers on AI fundamentals, the elite talent required to lead advanced projects is in short supply and command astronomical salaries. This wage inflation, combined with the need to invest $1 billion annually in learning and development and $1.5 billion in strategic acquisitions, is putting a squeeze on the firm's cost structure.
Furthermore, the firm is facing intensified pricing pressure from its Indian competitors, who are also leveraging AI to drive efficiencies. Firms like Tata Consultancy Services, TCS, maintain much higher operating margins, 24–26%, compared to Accenture's 16%, and have begun passing their AI productivity gains to clients at lower prices. This AI-led deflation forces Accenture into a difficult choice: lower its prices to remain competitive, sacrificing its own margins, or maintain its premium pricing and risk losing market share to leaner rivals. The bear case posits that as AI commoditizes many traditional IT tasks, such as application maintenance and testing, the premium that Accenture can charge for its services will inevitably erode. If the firm cannot find enough high-value consulting work to offset the pricing pressure in its managed services and operations segments, the double-digit EPS growth that investors have come to expect will be mathematically impossible to sustain. The final bearish argument concerns the stock's valuation and the composition of its balance sheet. Despite the recent pullbacks, Accenture continues to trade at a multiple that assumes it is a high-growth technology beneficiary rather than a mature professional services firm. From a traditional value perspective, the company's $178 billion market capitalization is heavily detached from its tangible assets. As of fiscal 2026, Accenture's balance sheet carried a massive $22.5 billion in goodwill, up from $15.6 billion just 2 years earlier. This goodwill represents the premium paid for acquisitions. In an industry undergoing radical disruption, there is a significant risk that the underlying value of these acquired firms will deteriorate, leading to massive non-cash impairment charges in the future. Bearish analysts also highlight the negative competitive advantage period, CAP. Quantitative modeling suggests that at current prices, the market is pricing in an infinitely improving competitive advantage, ignoring the very real operational pressures and macro headwinds described previously. To justify a PE multiple in the 17 to 20x range, while revenue growth is stuck in the 3 to 5% range, requires an aggressive assumption about future margin expansion that may not be feasible. Furthermore, the resilience of Accenture stock during previous crises may be a misleading indicator for the future. While the global financial crisis saw a 37.5% drop and the recent inflation shock caused a near 40% decline, the current AI shock is different because it is structural rather than cyclical. If the market realizes that Accenture's business model is becoming structurally obsolete due to AI automation, the PE multiple could contract toward that of a utility or a slow-growth legacy tech firm of 10 to 12x.
The lack of a margin of safety is the central concern here. If the bullish narrative of hyper-growth through AI fails to materialize in the next 12 to 18 months, the stock has significant room to fall further. For investors, the risk is that they are paying a premium price for a company that is in the midst of its most dangerous and uncertain transition in history, with no guarantee that the outcome will favor human-led services over machine-led automation. Conclusion: the investment thesis for Accenture is defined by a deep tension between record-breaking current performance and existential future risks. On the one hand, the company's financial architecture remains incredibly strong. A firm that can generate $11 billion in free cash flow, return $9 billion to shareholders, and secure $80 billion in annual bookings is undeniably a dominant force in the global economy. Its $3 billion AI investment has already positioned it as the primary architect of enterprise-scale AI, with its workforce of 85,000 professionals and its proprietary Gen Wizard tools, providing a moat against smaller competitors. On the other hand, the AI paradox is not a theoretical threat, it is an active force.
The spike in voluntary attrition to 16% and the fact that cost of services is outgrowing revenue suggest a business model under immense internal strain. The muted consulting demand and the 1% drag from the federal business highlight a macro environment that is increasingly hostile to discretionary, labor-intensive projects. Ultimately, the decision to invest in Accenture rests on one's belief in the reinvention narrative. If the firm can successfully pivot to non-labor-based revenue streams and become the essential orchestrator of agentic AI for the Fortune 500, it will likely continue to deliver the steady double-digit EPS growth and dividend increases that have made it a cornerstone of many portfolios. However, if AI-led pricing deflation and labor cannibalization happen faster than the firm can acquire and integrate new capabilities, the stock's current valuation will appear increasingly precarious. For most investors, the prudent approach is to view Accenture not as a safe haven, but as a high-stakes bet on the future of professional expertise in an automated world. The margin of safety remains thin given the structural uncertainties. Investors should closely monitor the book-to-bill ratio, currently a healthy 1.2, and the growth rate of managed services relative to consulting in the coming quarters to determine if the firm is successfully navigating this high-risk transition.